Hey everyone, this is Finance AG, and today I've got a critical update that every silver investor needs to hear. It's January 2026, and silver just took a shocking dive, dropping all the way down to $71 per ounce. That's right, from the highs we saw just weeks ago, silver's price plummeted, leaving many investors stunned and scrambling for answers. But here's the kicker. This sudden crash wasn't just market forces at work. Behind the scenes, a quiet rule change slipped in one that few people noticed, but that has massive implications for how silver is traded and priced. This change has shifted the playing field, impacting everything from futures contracts to physical silver availability. If you're holding silver or thinking about investing, you can't afford to ignore this. The market is more fragile and complex than ever, and understanding what's really happening could save you from costly mistakes. In this video, I'm going to break down exactly what caused this drop, explain the rule change that triggered it, and show you what it means for your investments moving forward. Before we dive in, make sure to hit that subscribe button, like this video, and share it with your friends who are watching the silver market closely. And don't forget to drop your thoughts and questions in the comments below. I want to hear your take on this silver shakeup. Silver's sudden plunge to 71 per ounce in January 2026 didn't happen overnight. It was the result of a series of events unfolding over several weeks that caught many investors off guard. Let's walk through the timeline and key moments that led to this dramatic decline. Late November to early December 2025, silver was riding high, trading near $95 per ounce. Investor enthusiasm was strong, fueled by inflation fears, supply shortages, and robust industrial demand. Many believed silver was on the cusp of a sustained bull run. Mid-December 2025, the first signs of trouble appeared. Economic data started showing signs of cooling inflation, and some industrial demand indicators softened. Silver prices began to wobble, dipping slightly but still holding above $90. Late December 2025, a quiet but significant event occurred, a rule change in the futures market that altered how delivery and margin requirements were handled. This change wasn't widely publicized but had immediate effects on trading behavior. Some large traders began adjusting their positions, leading to increased volatility. Early January 2026, the market reacted sharply. Silver prices started to fall more rapidly, breaking below key support levels around $85. Trading volumes spiked as panic selling set in, and short sellers gained confidence. Mid-January 2026, the price decline accelerated. Silver dropped from the mid-80s to the low 70s within days. This was accompanied by reports of physical silver shortages and dealers freezing sales, adding fuel to the fire. The disconnect between paper silver prices and physical premiums widened dramatically. January 20th, 2026, silver hit its low point at $71 per ounce, marking a nearly 25% drop from its recent highs. The sharp decline shocked many investors who had expected prices to continue climbing. Throughout this period, market sentiment shifted from bullish optimism to cautious fear. The quiet rule change played a pivotal role by tightening trading conditions and forcing some large holders to liquidate positions quickly. Combined with economic data suggesting inflation might be easing, the market found itself in a perfect storm. In summary, silver's price decline was a multi-step process influenced by both fundamental data and structural market changes. Understanding this timeline helps investors see that the drop wasn't only at random, but driven by real shifts in market dynamics. Have you ever wondered what could make the price of a precious metal like silver suddenly plummet? What if I told you it wasn't a global recession or a massive new discovery, but a quiet, almost hidden rule change that sent shockwaves through the entire market? In January 2026, that's exactly what happened. A subtle but powerful adjustment in the silver futures market fundamentally altered how silver is traded and priced. This change didn't make front-page news, but its impact was massive, directly contributing to a sharp drop in silver prices, some even seeing it hit $71 per ounce. Today, we're going to break down exactly what this rule change was, how it completely shifted the market dynamics, and what it means for anyone interested in silver. So, what was this mysterious rule change? It all happened on the COMEX Silver Futures Exchange, and it involved two key things: margin requirements and delivery protocols. Let's make this simple. First, the exchange significantly increased the initial margin. Think of margin as a down payment. It is the amount of money a trader has to put up to open or maintain a futures position. Before this change, traders could use a lot of leverage, meaning they could control huge amounts of silver contracts with a relatively small upfront investment. The new rules demanded a much larger down payment, forcing traders to commit way more of their own capital. Second, the rules around the physical delivery of silver became much stricter. Previously, the delivery process was more flexible. Traders could often roll their contracts over to the next month or settle in cash without ever having to physically hand over or receive actual silver bars. But the new rules tightened this up, making it much harder to avoid physical delivery. The goal was supposedly to reduce excessive speculation and make sure the futures market better reflected the real-world supply and demand for physical silver. Now, how did this seemingly bureaucratic tweak completely upend the market? The immediate effect was a massive shock, especially for leveraged traders, those who were using borrowed money to make big bets. With higher margin requirements, many of them suddenly faced what's called a margin call. This is when your broker demands you add more money to your account immediately, or they will force sell your positions to cover the losses. This triggered a huge wave of selling pressure as traders scrambled to get out of their positions and reduce their risk. At the same time, the stricter delivery rules created another problem. Traders who had shorted silver, meaning they bet the price would go down, could no longer easily avoid delivering physical silver. Suddenly, they had to either find actual physical silver bars to deliver or close their positions at any cost. Given the reports of ongoing physical silver shortages and shrinking inventories in warehouses, this created a classic short squeeze, but in a very strange way, putting immense pressure on short sellers and cranking up the market's volatility. The market's reaction was swift and brutal. This rule change exposed the incredibly fragile balance between the paper silver market, the world of futures contracts, and the physical market for actual silver. Traders who had built their strategies on low margins and flexible delivery found themselves in a very vulnerable position. The increased capital requirements sucked a lot of liquidity out of the market. Liquidity is just the ease with which you can buy or sell. When it dries up, it becomes harder to enter or exit positions smoothly, which leads to wild, sharp price swings. The silver price, which had been influenced by a lot of speculative activity, faced a sudden and severe correction as all these leveraged positions were forcibly unwound. What was really confusing for many people was that this rule change blew up the gap between the paper silver price and the premiums on physical silver. Because delivery became so much stricter, getting your hands on physical silver became even harder and more expensive compared to the futures price you saw on your screen. This created a lot of confusion and, for some, outright panic. So why did regulators and exchange officials even do this? The official line was that these changes were meant to curb excessive speculation and reduce systemic risk in the financial system. For years, the silver market has been plagued by allegations of price manipulation and has experienced extreme volatility. By tightening the rules on margin and delivery, the stated goal was to make the market more transparent and bring it more in line with physical reality. However, the timing and the sheer scale of the change caught almost everyone by surprise, and it triggered a cascade of unintended consequences. Instead of stabilizing prices, the initial effect was a violent price correction and a huge spike in uncertainty. Understanding this rule change is absolutely critical for any investor. It's a powerful reminder of how regulatory shifts can dramatically reshape market dynamics, especially in a complex market like silver. The new landscape means that future price moves are likely to be more volatile and more closely tied to the real-world constraints of physical supply. Now, let's look at how different players reacted, because their responses are what created the market chaos. Think of it like a chain reaction involving banks, traders, and individual investors. Each group had a different reaction, and understanding them helps explain the sharp price moves that followed. Let's start with the big banks. Institutions like JP Morgan and Bank of America are massive players in the silver futures market. Many of them historically hold significant short positions, essentially betting that silver prices will fall or stay flat. When the new margin and delivery rules hit, it was a major blow. Suddenly, they needed much more capital to maintain those huge short positions. This forced some of them to either pour more money into their accounts or start unwinding their positions. Given the tight physical silver supply, trying to buy back those shorts became incredibly difficult and expensive. So what did some of them do? They started liquidating, which added even more selling pressure to a market that was already starting to crack. On top of that, the stricter delivery rules meant they could no longer just shuffle paper around. This created a delivery squeeze, forcing banks to scramble to find physical silver to deliver on their contracts. The scarcity of physical silver pushed premiums sky high and massively increased costs for these institutions. Next up, we have the traders, the speculators and hedge funds. These are the players who often use a lot of leverage to amplify their potential gains, and they were among the most vulnerable. The hike in margin requirements triggered a flood of margin calls. For many, this meant a forced liquidation of their positions. Imagine building a complex strategy, only to have your broker sell everything out from under you. This led to rapid, panicked selling and fueled the volatility. Hedge funds that had bet on rising or stable prices found themselves completely squeezed. The new delivery rules also forced a strategic rethink. Traders who used to just roll their contracts from one month to the next now had to face the real possibility of physical delivery. Some just packed up and left the market entirely, while others shifted their focus to buying physical silver directly or looking for other assets to trade. The game had changed, and not everyone was prepared to play by the new rules. The easy leverage was gone, and the risks had multiplied overnight. And what about the everyday investors, both retail and institutional? Retail investors, the people buying silver coins, bars, or investing through ETFs, were left mostly confused and concerned. The growing disconnect between the futures price and the actual cost of physical silver became impossible to ignore. Many saw the price on the news dropping, but when they tried to buy a silver eagle, the premiums were higher than ever, and dealers had limited stock. This scarcity and price volatility caused a lot of anxiety. Some decided to just wait on the sidelines for the market to make sense again. Institutional investors, like pension funds, took a more calculated approach. They watched the rule changes and market reactions very closely, adjusting their portfolios to manage risk. Some decided to increase their holdings of physical metals, while others diversified away from silver futures altogether. The overall impact of all these reactions was a vicious feedback loop. The bank's forced selling and delivery problems increased volatility, which spooked the traders and investors, leading to even more selling and cautious behavior. The reduced liquidity for market makers just amplified the wild price swings. This perfect storm is what contributed to the sharp drop in silver prices and the widening chasm between the paper and physical markets. It laid bare just how fragile the silver market really is and how a single regulatory change can trigger a major price disruption. So, what does this all mean for you? Understanding how these different players, the banks, the traders, the investors, reacted is key to seeing the bigger picture. The silver market isn't just about simple supply and demand. It's heavily shaped by the actions, constraints, and strategies of powerful institutions and traders. Being aware of these complex dynamics can help you better navigate the market's inevitable ups and downs. The January 2026 rule change was a turning point. It signaled a shift towards a market where physical supply and regulatory oversight play a much bigger role. For anyone interested in silver, staying informed isn't just a good idea, it's essential for survival. The market is evolving, and this event marked a significant new chapter in how silver is traded and valued around the world. The January 2026 rule change fundamentally altered the relationship between physical silver and paper silver prices, deepening an already troubling disconnect that has significant implications for investors and the market as a whole. Understanding the disconnect. Before diving into the impact of the rule change, it's important to understand the difference between physical and paper silver. Physical silver refers to actual metal bars, coins and rounds that investors and industries can hold and use. Paper silver, on the other hand, includes futures contracts, ETFs, and other financial instruments that represent claims on silver but don't always correspond to real metal. Historically, the prices of physical and paper silver have moved closely together. However, in recent years, a growing gap has emerged. Paper silver prices have often been suppressed by large financial institutions through short selling and market manipulation, while physical silver prices have risen due to real-world supply shortages and strong demand. How the rule change widened the gap. The January rule change increased margin requirements and tightened delivery protocols on silver futures contracts. This had several effects that intensified the disconnect. 1. Increased pressure on physical delivery. With stricter delivery rules, traders holding short positions could no longer easily avoid delivering physical silver. This forced many to scramble for actual metal in a market already suffering from supply shortages. The increased demand for physical silver pushed its price higher, while paper prices remained influenced by trading dynamics. 2. Reduced liquidity in paper markets. Higher margin requirements meant fewer traders could afford to hold large futures positions. This reduced liquidity in the paper market, making prices more volatile but also less reflective of physical supply and demand. The paper market became more detached from the realities of physical silver availability. 3. Physical silver. Scarcity and premiums. As delivery demands increased and inventories shrank, dealers raised premiums on physical silver products. These premiums represent the extra cost investors pay over the paper price to obtain actual metal. The rule change accelerated this trend, making physical silver significantly more expensive relative to futures prices. 4. Market confusion and investor behavior. The widening gap confused many investors, especially retail buyers who rely on paper prices as a benchmark. Some were misled into thinking silver was cheaper than it really was, leading to frustration when physical silver became scarce or prohibitively expensive. Broader implications. This growing disconnect undermines confidence in the silver market's price discovery mechanism. When paper prices don't reflect physical realities, it creates opportunities for arbitrage, but also risks market instability. Investors holding paper silver contracts face counterparty risk, the possibility that contracts won aren't to be fulfilled with actual metal. The rule change, while intended to bring more transparency and reduce speculation, inadvertently highlighted the fragile balance between paper and physical silver. It exposed how dependent the market is on a small pool of physical inventory and how vulnerable it is to regulatory shifts. What investors should know for investors, this means paying close attention to both paper and physical silver markets. The paper price alone no longer tells the full story. Understanding premiums, delivery reports, and inventory levels is crucial to making informed decisions. In summary, the January rule change deepened the divide between physical and paper silver prices, revealing a market under strain and signaling that investors need to be more cautious and informed than ever. The sharp drop in silver prices to $71 and the quiet but impactful rule change in January 2026 have sent ripples far beyond just the silver market. These events carry significant implications, not only for silver, but for the entire precious metal sector and the broader financial landscape. Silver market, a turning point. For silver, the price drop marks a critical juncture. The rule change tightened trading conditions by increasing margin requirements and enforcing stricter delivery protocols, which forced many leveraged traders, especially those with large short positions, to adjust or liquidate their holdings. This led to increased volatility and a rapid unwinding of positions, contributing to the price decline. However, this correction doesn't necessarily signal the end of the silver bull market. Instead, it highlights the market's fragility and complexity. The disconnect between paper and physical silver prices remains a core issue. Physical silver shortages persist, and premiums continue to rise, indicating that the underlying supply-demand imbalance is still very much in play. The rule change also serves as a wake-up call for regulators and market participants. It exposes vulnerabilities in the futures market infrastructure and the risks posed by excessive speculation and leverage. Moving forward, we can expect increased scrutiny and possibly more regulatory adjustments aimed at stabilizing the market and improving transparency. Impact on other precious metals. Silver's turmoil often foreshadows or parallels movements in other precious metals, particularly gold. Gold, traditionally seen as a safe haven, has also experienced heightened volatility amid inflation concerns, geopolitical tensions, and monetary policy shifts. The silver price drop may temporarily cool investor enthusiasm for precious metals, but the fundamental drivers, such as inflation fears, currency debasement, and global uncertainty, remain intact. Gold prices have held relatively firm compared to silver, underscoring its role as a more stable store of value. Moreover, platinum and palladium, metals critical to industrial applications like automotive catalysts, are also influenced by supply constraints and demand shifts. The broader precious metals complex is interconnected, and disruptions in one market can cascade into others. Investor sentiment and market dynamics. The recent events have injected caution into investor sentiment. Some retail investors may hesitate to enter the market, fearing further declines or manipulation. Institutional investors are likely reassessing risk and adjusting strategies to account for increased volatility and regulatory changes. At the same time, savvy investors recognize that corrections and rule changes are part of market evolution. These moments can create buying opportunities for those who understand the fundamentals and are prepared for short-term fluctuations. Long-term outlook. In the long run, the silver market OS challenges underscore the metal S unique position as both an industrial commodity and a precious asset. Supply constraints, growing industrial demand, especially from green technologies, and macroeconomic uncertainties continue to support silver's value. The rule, change, and price drop are part of a broader maturation process for the silver market, pushing it toward greater transparency and stability. Investors who stay informed and patient may find significant rewards as the market adjusts and evolves. Navigating the silver market after the recent price drop and rule change requires close attention to several key indicators and signals. Monitoring these will help you stay ahead of market shifts and make informed decisions. 1. Physical silver. Inventories. One of the most important indicators is the level of registered silver inventories held in major vaults like COMEX and the London Bullion Market Association, LBMA. These inventories represent the physical silver available for delivery against futures contracts. A continued decline signals tightening supply and potential price pressure, while stabilization or increases may indicate easing scarcity. 2. Delivery notices and demand. Keep an eye on delivery notices, the number of futures contracts standing for physical delivery. A surge in delivery demands often precedes price volatility and can indicate that traders are moving from paper contracts to physical silver, signaling real market stress. 3. Premiums on physical silver watch. The premium investors pay over the paper price for physical silver coins and bars. Rising premiums suggest growing scarcity and strong demand for actual metal, while falling premiums may indicate easing supply or reduced buying interest. 4. Futures market. Open interest and positioning open interest. the total number of outstanding futures contracts, and the positioning of large traders, long versus short, provide insight into market sentiment. A high level of short positions combined with low inventories can set the stage for a short squeeze, while a balanced or long-heavy market may signal stability. 5. Inflation. Data, since silver is often used as an inflation hedge. Tracking inflation rates and related economic indicators like the Consumer Price Index, CPI, is crucial. Rising inflation typically supports higher silver prices, while cooling inflation can reduce upward pressure. 6. Monetary policy. Signal central bank policies, especially from the Federal Reserve, impact silver prices. Watch for changes in interest rates, quantitative easing, and statements about inflation. Tighter monetary policy can strengthen the dollar and pressure silver prices, while looser policy tends to support precious metals. 7. Geopolitical developments. Global tensions, trade disputes, and political instability can drive safe haven demand for silver. Stay informed about major geopolitical events that could influence market risk sentiment. 8. Industrial demand. Trends monitor demand from key industrial sectors like solar energy, electronics, and electric vehicles. Growth or contraction in these areas directly affects silver consumption and price dynamics. By keeping a close watch on these indicators, you'll be better equipped to understand market movements and position yourself wisely in the evolving silver landscape. The silver market today is complex and volatile, shaped by recent rule changes, supply constraints, and shifting investor sentiment. To protect your investments and make smart decisions, here's some practical advice on how to navigate this challenging environment. 1. Focus on physical silver. Given the growing disconnect between paper silver prices and physical silver availability, prioritize owning physical silver, coins, bars, or rounds from reputable dealers. Physical silver provides tangible ownership and protection against risks like delivery failures or market manipulation that can affect paper silver products, such as ETFs or futures contracts. 2. Buy gradually and strategically, avoid rushing to buy large amounts all at once, especially during volatile periods. Consider dollar cost averaging, buying smaller amounts regularly over time, to reduce the impact of price swings and avoid buying at short-term peaks. 3. Stay informed and monitor. Key indicators: keep a close eye on market indicators like inventory levels, delivery demands, premiums on physical silver, and inflation data. Staying informed helps you anticipate market shifts and make timely decisions rather than reacting emotionally to price volatility. 4. Diversify your portfolio. While silver can be a powerful hedge, don't put all your eggs in one basket. Diversify across other precious metals like gold, as well as inflation-protected securities, real estate, and other asset classes. Diversification helps manage risk and smooth out returns during turbulent times. 5. Secure your holdings. If you own physical silver, ensure it's stored securely. Options include home safes, bank safety deposit boxes, or professional vault services. Proper storage protects your investment from theft, loss, or damage. 6. Be patient and avoid panic market. Volatility can be unsettling, but silver's long-term value is tied to fundamental factors like supply constraints and inflation. Avoid panic selling during dips and focus on your long-term investment goals. 7. Consult trusted advisors. If you're unsure about your strategy, consider consulting financial advisors who understand precious metals and can help tailor a plan suited to your risk tolerance and goals. By following these steps, focusing on physical silver, buying strategically, staying informed, diversifying, securing your assets, and maintaining patience, you can better navigate the current silver market and position yourself for future opportunities. To sum it up, the silver market is facing unprecedented challenges right now. The recent rule change and price drop to 71 have exposed deep cracks between paper silver and physical silver markets. Inventory shortages, delivery demands, and market volatility mean the $90 price you see on screens doesn't tell the full story. If you're invested in silver or thinking about it, now is the time to be cautious and informed. Focus on securing physical silver from trusted dealers, buy gradually, and keep an eye on key market indicators. Diversify your portfolio and avoid panic moves during volatile swings. The urgency is real, this market is evolving fast, and those who act wisely will be better positioned for what's next. I want to hear from you. How are you navigating this silver market shakeup? Drop your thoughts and questions in the comments below. If you found this video helpful, please like it, share it with your friends, and don't forget to subscribe for more insights and updates. Your engagement helps us bring you the latest financial news and analysis. Thanks for watching Finance AG, and stay tuned for more.